year ago today, Jay Powell raised rates for the fourth time in that year, and the stock market was in the middle of its worst December since the crisis. Today, stocks are at record highs, and things look quite a bit different for the economy. Joining us now to discuss where we go from here is Keith Lerner. He's the Chief Market Strategist at SunTrust Advisory Services. So, Keith, in your 2020 outlook, you guys are saying it's 2 steps forward and 1 step back. So how exactly are you defining that? And I guess that sounds to me like, I guess everything will be fine.
Well, I'm sure we'll have some of these carousel of concerns continue. That was our theme from last year, as you know. We do think overall the economy grinds forward. We think the market or the equity market is still attractive on a relative basis. However, what's a little bit more challenging is we have more of the good news in the market, right? Last year, we had all of these uncertainties. As some of these uncertainties proceeded, it provided catalysts for the market. So I think now the market's going to be looking at what's the next catalyst to move us higher. We think it's going to be a global economy that's firming, and we think people have become a little bit too bearish on the U.S. economy. We think the economy here domestically grows about 2.3%. So we think it's going to be more like an average year for the stock market, but still relatively good. One last thing, Miles, just as a stat for you. We've had about 24 years where we've seen the market move up 20% or more. The next year, the market has moved up 79% of the time, and the average gain is about 13%. That's actually a bit higher than we expect for next year. But just to give you some context that after big years, you tend to actually see gains the next year as well.
Is that just people chasing performance, though, Keith, or like just running on fumes? Or, I mean, is there a fundamental case to that, or do we just
as far as the next year being strong? Well, I think it's like markets tend to, a topping process takes time, and I just think that there tends to be some carryover, so some momentum after these big up years. But as you mentioned, you can't look at these things in a vacuum. I think it's really one of those stats that says, I think people say after these big up years, we need to have a negative year or a really flat year, and the history doesn't support it. I would take that as the first step, and then layer on the fundamental and economic backdrop.
Now, Keith, this day last year, it was the Fed's last meeting of the year, so this calendar was a little bit different. You were on the program, and you made a very interesting call for 2019. We have a quick clip here we want to have you listen to.
I would say one thing that I think is actually getting positive, as far as we are having a buyer strike right now, but a lot of the sentiment things that I look at as we look into next year, I think we are bringing down expectations so much that we're getting to a point where next year where the hurdle rate for positive surprises is pretty low. And again, I would say it's almost the opposite of what happened last year.
All right, so I think that worked out, right? The hurdle rate came down, stocks went up a lot this year. But as I hear you kind of talk through the beginning of your outlook for 2020, I sort of wonder if you see a repeat of 2018 setting up, right? Everything has come up so nicely over the last 6 weeks. The market's going into next year at a record high. Are we setting ourselves up to be really disappointed, excessively disappointed perhaps at some point next year?
Yeah. The first thing, Miles, before you put that clip, I got a little bit nervous, so I'm glad that's
no. Hey, only nice things here, Keith.
Yeah.
Okay. No, and I said that's the biggest difference. Last year we thought expectations were so low, just a little bit of good news could go a long way. The more challenging for the market this year is that expectations are up. We've seen a lot of these catalysts as far as on the trade side, the Fed, even on the UK side. So if you ask, hey, what's the biggest risk to the view, is that a lot of positive news is in. However, again, as you look at it for today, I think what that means is a much more modest move for the equity markets, still likely positive, but it's going to be one of those things where you probably have a better global economy and more modest stocks, which sounds a little bit counterintuitive for some folks who don't watch the market as much, because the market is a discounted mechanism.
So I guess the question becomes, how do you position yourself, given what you now see as we've just had this big year. Usually we have another up year. We also have the political cycle during an election year. You point out that's usually pretty good. You still have a U.S. bias. So explain that, because you were just talking about the global economy also looking good. Why not go and run after EM or jump into Europe now that we kind of know what's going to happen? Boris Johnson just winning in a landslide. Why not move that way?
Yeah, no, it's tempting. I think that's where the consensus is right now. I will say that we're staying with the U.S. bias. Primarily, we think, as people think about the global economy, we still think the U.S. is going to be an outperformer. If you look at the IMF, they're thinking the U.S. is going to grow about 1.8. We think it's closer to 2.3. The other thing, even though we think we're going to have a global recovery, we think it's going to be more modest than what the consensus thinks right now. Normally, for international markets to really outperform, you need to have a robust global economy and really strong interest rates, because a lot of these international markets are much more interest rate sensitive. So listen, I definitely think that EM and developed markets will do better, but we still think the nod is to the U.S. again. But there's probably going to be more of a convergence in performance. And Jennifer, if you don't mind, maybe I can just highlight one area within international that we actually think is an opportunity. We just became more positive on small cap international. We've moved out of that asset class a few years ago, got more negative on it. But what's going on now is that small cap international stocks have underperformed. They're about 10% below their former peak. And as the chart you just moved up, right now, liquidity is increasing via the central banks. Historically, as you have increased liquidity as far as balance sheet purchases by the ECB and the Fed or Bank of Japan, that environment is good for international small caps. Valuations are attractive. So within international, we think there's room for catch up with the small cap space specifically.
All right, Keith Lerner, thanks for joining us. Have a great holiday. We will talk to you
Thanks
in
so
the
much.
new
Happy
year.
holidays, guys. Look forward to working with you next year.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.